In this presentation, we're going to introduce the financial statements and explain why profit and cash are different. In order to do this, we're going to first define what accounting is. We're then going to explain what the properties and conventions of accounting are, and then introduce the three financial statements. We're then going to look at the financial concepts related to these financial statements, and then give a brief introduction into how to go about constructing these financial statements. So what is accounting? Accounting is defined as the recording of the financial transactions of a company in a financial period. From this, agents with this information can make better judgments and decisions. We're going to be interested in financial accounting, which is for the use of agents excluding the managers, such as suppliers and employees of the business. So what are the properties of financial statements? Firstly, relevance. This is where a transaction is only reported if it will influence used decisions. If a transaction does not fit this criteria, then it should not be included in the financial statement. Faithful representation. This means information is complete and without bias. Should estimates need to be made, then they need to be made accurately. Both of these properties are needed for the financial statements to be valid and useful to the user, that is, to be able to influence their decisions. So what are the three types of financial statements? Firstly, the cash flow, physical movement of cash in and out of the business. We then have the income statement, which is sales minus the various costs for that particular financial period, and these both feed into the balance sheet of the financial position of the company at a period in time. These are best illustrated by an example. Here we have 5 days of financial activity from a typical technology firm. Firstly, consider the cash flow. Cash into the business comes on the 5th day, where a computer is sold for £250. Cash going out of the business of the two computers bought on the 1st and 3rd day, £250. This gives a net cash flow figure of £25. Moving on to the income statement, we have revenue at £400 from the sales on the 4th and 5th days. The costs of these two computers sold are £300, and we also have to take off the wages for the period, £50, giving an operating profit figure of £50. The balance sheet, firstly the assets, these will be defined later. We have the unsold computer, bought on the 3rd day, at £125. We have the credit sales, known as debtors, £150. We also have the cash from the cash flow statement, £25, giving assets of £300. Then we have the equity, we have the retained profit from the income taken directly from the income statement, £50, giving total equity of £50. We also have the liabilities, trade payables, which is credit purchases, £200 for the computer bought on the 2nd day, and the accrued wages of £50, which have not yet been paid by the business, giving total liabilities of £250. So we can see that the net cash flow figure and the operating profit figure are different, but why is this the case? The reason for this is the accruals principle. This is where transactions are recorded in the period they occur rather than the period in which the cash flow related to them occurs. Therefore, the revenue in the income statement includes both the cash and credit sale. However, the credit sale has not yet been paid in cash by the customer, and is not therefore included in the cash flow statement. However, we do record in the balance sheet a debtor, something that is owed to the business. We can therefore see why the net cash flow figure and the operating profit figure are not the same. The accruals principle is a subset of the matching principle. This is where expenses are reported on the income statement in the same period as related revenues. From our example, these are wages. These have been incurred in the financial period we are interested in, but not yet paid by the business. We therefore record the expense of the wages in the income statement, and also record them as a liability, something that is owed by the business, in the balance sheet. As these wages have not yet been paid in cash, they are not included in the cash flow statement. Our example also highlights the accounting equation. This is that total assets equals total liabilities plus total equity. And this always holds. We can see that 300 equals 50 plus 250. Now we're going to explain some of the terms in the balance sheet. Firstly, assets. These are resources held and owned by the business, such as equipment and cash. Liabilities are claims against the company, which exclude the owners. These include trade payables and overdrafts. Current assets and liabilities are those that are held for less than a year. An example of a current asset are debtors. Non-current assets and liabilities are held for more than a year. An example of a non-current liability is a bank loan. We also have equity. These are claims of the owners against the business, such as shareholders. So how do we go about putting together these financial statements? We do this through the notion of duality, which is recording transactions in two columns via debits and credits. A debit is the increase in the value of an asset or decrease in the value of equity or liabilities, and is always included in the left half of the two columns. A credit is the opposite of this, a decrease in the value of an asset or an increase in the value of equity or liabilities, and this will always be recorded on the right half of the two columns. As earlier, these are best illustrated by a few examples. From our example earlier, a computer is bought for £200 on credit. This increases the value of an asset, i.e. debtors, and is therefore a debit and recorded on the left half of the two columns, a value of £200. This also increases the value of equity in the income statement, and hence is a credit and recorded on the right hand side as £200. Taking another example, there are £50 of wages to be paid for the period. This increases the value of a liability, accrued wages, and hence is a credit of £50 recorded on the right half. This also decreases equity via the income statement, hence is a debit and recorded on the left half as £50. One thing to note is the accounting equation holds for each transaction, and always will. In the first example, there is an increase in assets by £200, and this equals the increase in equity by £200. In the second example, the increase in liabilities £50 is counteracted by a decrease in equity of £50, equaling no change in the value of assets. Also, these examples highlight that for every debit there is a credit, and again, this will always be the case. Thank you for listening.